This is Gary Cotterill, and I'm talking over a very simple strategy that makes good money consistently. It's basically an SPX, 0 days to expiration, end of day rapid theta trade. And what it does is you get in right before the close on an expiration day with an out of the money spread based on which way the market's going. If it's going down, you basically sell a call spread, and if it's going up, you sell a put spread. And it's fairly simple. And once again, you just start looking at it somewhere around 11:30 in the morning, looking for which direction the market's most likely to move in that last hour or so, and then you place the trade. The theta decay is extremely rapid during that time period, and here's some examples. This is the month of August 2021, and here's August 2nd, the first expiration of the month, and it brings in $1,580. The green zone basically is in the case of the calls, the bottom is a short strike and the top is the long strike for protection to make sure it doesn't go against you too badly. Over here to the right, we have the description of what actually happened, what the prices of the options were. In this case, it brought in $1.58 credit per share. 10 contracts were traded and brought in $1,580 worth of credit. Those, as you can see, the price was far below that spread, and basically everything expired worthless. The next trade, a couple days later, is $1,260. And it was brought in $1.26 of credit on 10 contracts, so that's $1,260. The risk in this case was $37.40. The rest, in other words, like the difference in the strike between the strikes, $5 minus the credit received, gives you your risk amount. Okay, once again, that one basically gives a trigger here to go short, and basically expired out of the money. Actually, all of August expired out of the money on all of these trades, so it's actually a pretty good thing. The next one was not as big a winner, only $850. And that was because, well, a couple things can cause that to be the case, because we're further out of the money when we get in the trade, and the strikes to get into the 44.35 strike would have been kind of in a danger zone for getting in at this point. So the odds of winning are a lot lower when you do that. I mean, you can still win, and it would have won because the price would have been above that 44.35 price. But this was a much surer thing at $850 profit. The next day, on the 9th, on Monday the 9th, basically it only brought in 60 cents worth of credit, 10 contracts, $600 received, risk $4,400, but the chances of it going anywhere near it during that day were pretty slim. So, while the risk is higher as far as dollars go, the odds of winning were extremely good. Okay, next one down brought in $1.47 worth of credit, which comes out to $1,470 on 10 contracts. Okay, this one actually did dip down into that area a little bit, but closed above. So it did take a little bit of heat. Most of them don't take heat, but this one, as you can see, the the short strike on the put was excuse me. The short strike on the put was right at the money pretty much when you got that signal. So that's when you see some of this heat taken. Sometimes it can actually dip down in there, but I haven't had that happen. Okay, the next one is $640 received on the 13th. It's also expired worthless, only 64 cent credit on that with 10 contracts, so 640 bucks. Fairly flat day. I'm sure volatility was pretty low, so didn't yield a whole lot, but 640 is still more money than you had yesterday. The next day was the next trading day on the 16th, Monday the 16th, was $980 received with a risk of 4,020. Also expired worthless. And then we go for the next day, which is the Wednesday. We made quite a bit on this one, 28.50, and you'll notice that the volatility is huge. The movement is gigantic on these deals. So in this case, took on a trade where the short strike was pretty close to where you got in. Here's the entry signal. And this thing took off to the downside, and it really had a lot of movement that day. So 28.50 is a goodly number to pull in. Next trading day was on the 20th, and that one pulled in $1,700 worth of credit, and once again expired out of the money, and both expired worthless. The next one was, let me get back here to, okay, the next one was the 25.50 trade. Now this one here, the candle was actually in, had started inside the box of the $5 spread that was being put on. So that was pretty close, and so that's why we got so much credit on that trade. 25.50, there we go. And then on the 25th, our next day, at 7.50 for that one. The next trade we didn't do, which was, it was too flat. There was basically no credit in there worthy of it. Basically, it would have been 45 cents minus 9 cents. I mean, 36 cents credit that's not worth putting on that kind of risk. So we didn't do that trade. And not trading is a valid strategy. The next one, 16.70, brought in from the options on that one. And once again, we started pretty close to the price. Our short strike was pretty much where we started. If this had reversed, which it can do very easily, like it did here, but it sold off into the close, and that was a good trade. So 16.70. Now, good news is for the month of August, the total was $16,900. The largest risk on any trade was $4,400. So that's 384% return on capital, return on risk. I would say this strategy is pretty healthy. So let's move on to the September trades that have been done so far. 9.1 over here. There we go. 650 bucks on 9.1. Could have taken the trade closer to the money, but we didn't. So 650 is all we get on that one. Could have got 1180 credit had we done it with the next lower call strikes. Then let's see, the next trade was 14.50. Okay, 14.50, and that one once again expired out of the money. Pretty healthy trade. Anytime you're over $1,000, it's a good trade. So let's see, on 9.7, we did another trade, and that one was actually $2,000 because we got really good credits on those. Once again, we started that trade with the strike actually in the money, so that's why we got a lot more credit for it. And luckily we picked the right direction. It could have reversed and gone against us, and we could have ended up in loser land, but we didn't. So that's all good news. That's on the 7th. That was after the Monday holiday, Labor Day. And then here on the 8th, we have a trade for $1,520, which is another one that perfect trigger, out of the money. And even though the price rejected and came back up, it still did not take us into the money before expiration. And that's one of the benefits of being in the trade only. We're talking from 12:25 until 1 o'clock as far as the clock goes here in the Pacific West Coast. So what do we make? 15.20, 35.20, another, we're up to about $4,000, and that's all in this month of September so far. So this is, I think it's one of my favorite trading techniques, and it does a great job of bringing in the cash and being pretty reliable. You are risking a lot more in capital, but there is nothing against closing these trades early if the price does go into the green zone and into the spread. So don't wait. If it goes in there, get the heck out. Don't lose the whole risk amount ever. That's just a bad plan. Okay, that's it for now. Remember, all of this is information and not suggesting that anyone trade anything. Disclaimer wise, we are not broker advisors or stuff like that. This is just informational for your own education, and if it works for you, great.